Welcome to Wall Street for Main Street podcast. My name is Mo Dawood. I'm the co-founder of Wall Street for Main Street, and right now we have Jason Burak with us, who is also the co-founder of Wall Street for Main Street. He's also a contributor to Curve Trading, and he also co-authored a rare earth report with Kevin called the Dragon Metals Report. Um, Jason also has a blog, jasonburak.com, that everybody can check out online. Jason, how you doing today?
Very good, Mo. Happy New Year to you.
Happy New Year to you too. Today I want to talk about your outlook for the year 2011. We will discuss the stock market, commodities, and the macroeconomic picture for this country, or actually globally, for 2011. Is that all right with you?
Sounds good, Mo. Fire away. I'm ready to start talking about 2011. If we review 2010 a little bit too.
Oh yeah, absolutely. Well, in 2010, the S&P was up 13% and the Dow was up 11%. Well, what's your thoughts on that?
My thoughts on that is right now there's not a humongous amount of margin compression for a lot of those multinationals with strong export businesses. But as you saw in the last quarter or two, you saw commodity prices, especially food prices and also the metals, start to really spike. And oil also started. So I look as a trend for 2011, I look for a lot of those companies that are higher up the value chain there. The the companies, that take the commodities and add value to them and that, can not necessarily pass on their input costs, I look for them to struggle to keep up with the rise in commodity prices and the dollar devaluation and some of the other inflationary things that we're going to be seeing in 2011.
That's an important. Could you give our audience an example of one company that could struggle up the value chain?
Well, let's talk about UPS or FedEx, who most of their business is dependent upon oil. So they have a humongous input cost with oil and energy. They have a lot of delivery trucks, planes, trains, the big U-Haul freighters, and then the actual ones that after the loading depot. So that would be one. Other ones would be restaurants here, where, they buy like wheat and flour and other, poultry and beef and stuff like that. And those input costs are just in the last 5 or 6 months, those input costs have gone pretty bananas. So that's going to be stuff that's going to be very hard for them to continue to pass on to their consumer and to have the same, profit margins. So that's what a Wall Street analyst would call margin compression. And basically what that means is these restaurants are going to struggle to maintain the same profitability as they struggle to control their input costs. And that's going to hurt the bottom lines for these restaurants, but also it's going to hurt the U.S. consumer because, when you and me sit down at a restaurant and, we want like a plate of lasagna at Maggiano's, which is, a very large and well-known Italian restaurant chain, and we expect, the same portion for $15 or $16 or $17 and it's 30 or 40% less, we're going to be upset about it. So that's the type of impact we're going to be seeing on U.S. consumers and also the companies that are higher up the value chain with these higher commodity prices and other inflationary forces.
So, are you saying that the general Main Street public will be able to actually notice inflation in 2011?
Yes, I think more so than before. I think there's a lot of Main Street people that are just starting to wake up now that are noticing, over $3 a gallon gasoline now at the pump. And it looks like we're trending higher for 2011. We might see $3.50, $4 a gasoline by the end of 2011 if the dollar is devalued in another 20% or so. So I definitely think that the Main Street people are starting to see this at, the grocery store. They're definitely food and energy, I think, Mo, are the first two things that people will see higher commodity prices and inflationary pressure as the dollar continues to be debased, devalued, inflated. Any of those three are synonyms, so you pick whichever one you want to use. I think that's the first couple places people are going to see those trends, but they're also going to see it, on some of the other consumer staples that people have to have in their everyday lives, that most human beings have to buy just to sustain like basic everyday modern life.
I agree. That's a good point. I mean, once people start going to grocery stores and they get their receipt and they notice that it looks a little bit higher than before, then they're going to start waking up and asking questions. Um, we're back to the stock market. The market went up in 2010 in nominal terms, but if you adjust it to inflation, it was actually in a negative territory. Do you agree?
Yeah, I about agree. I mean, maybe some of the S&P companies individually produced beat inflation, but in general, like the trends I'm seeing is that a lot of the companies are basically just, melting up, to use the national. I think that's a perfect description there of what we saw in 2010. I think a lot of the regular, the stalwarts of the Dow and some of the bigger companies in the S&P 500, I think you saw a melting up where a lot of these, larger money management firms, institutions, banks, hedge funds, like in their valuation models, as these currencies, and it wasn't just the dollar, a lot of these other, developed countries like in the G7, like British, UK, the Euro, and others, as these currencies became devalued, then you saw in their models how they updated the devalued currencies to force the stock prices higher. So rather than these firms necessarily holding on to a lot of cash, and some of them missed the 2009 rally or were late, so they tried to make up for a lot of it in 2010 and bid some of these stocks upwards. And they did kind of, inflation, it depends how you calculate inflation. If you want to use the Austrian school total money supply, or if you want to use John Williams' shadow stats definition, they did keep up with inflation this year pretty well to a certain extent. Definitely using John Williams' shadow stats, 6 to 7% inflation rate for the year. So I think that's going to taper off. I don't think we're going to see a lot of those bigger companies be able to pass their cost increases onto the consumer. So they're going to have to figure out clever ways to, stay in business, reduce portion size, cut some corners here and there. And that is going to upset a lot of consumers. But, like these businesses, their bottom line is to stay in business and to deal with the shareholders. So I think 2011 is going to be like an increase from what we saw in 2010 in the last couple quarters. I expect things to get worse, Mo, going forward.
Oh, I agree. I believe 2011 will be an era where we start seeing noticeable inflation, specifically in food and energy. But moving on to the general macroeconomic picture, the U.S. government and the Federal Reserve continued to print money in 2010. They recently announced the QE2, which is totaled to be $900 billion, which started a spike in the commodity industry. Silver and gold specifically started to go up a lot during the later part of 2010. So, talking about commodities, what are your thoughts on gold and silver for 2011?
I think gold lagged behind silver, to be honest, for a good portion of this year. I thought gold, like Jim Sinclair, that gold would would easily be over $1,500 an ounce by now. And I thought it would challenge the 1,600 to 1,650 mark that Jim Sinclair had set for this year. So I was quite surprised. I think there's a lot of value in gold right now, especially in the gold shares. So I think the gold stocks will do a lot of catching up in the gold price. I think gold will have a very good year. It will stop lagging some of the other commodities. And in general, I expect the commodities trend. I think that's the asset class to be, Mo. I really do. I've examined a lot of the other asset classes right now, and I think if people are diversified in the commodity sector, like if they pick out different commodities like gold, silver, rare earths, uranium, different energy plays, maybe a little bit of palladium, some base metal exposure, if they're nicely diversified in there, I think 2011 will be a very good year for them. Now, if they want to spend more time in research going in there and picking out more individual winners, then fine. But I cannot find a better asset class than commodities right now, given all the exposure, given the inflationary pressures around the world, especially in the developing countries. As UK, the inflation ramps up there. These European countries are implementing quote unquote austerity, but it's really, a lot of hidden bank bailouts and other stuff still, that are basically inflationary. And also the emerging market growth here as these other countries in developing areas, like South America, Africa, India, and of course China, as people in these countries and emerging middle class develops. And, they want the basic stuff in life that we take for granted, like a nice cell phone, maybe a laptop computer or a netbook computer, nice electronic stuff, maybe a car. Maybe they chipped in with everyone in their family and paid cash, for like a decent car. So there's one family car now, and better food. So I think commodities are by far the best asset class to be. Obviously we might have some pullbacks here or there if the dollar does strengthen, and people do panic, because these hedge funds are over levered. But I think those are buying opportunities. I really do. I think the trend is very much intact higher, and I don't see anything in my macroeconomic research that changes that.
I agree. What about silver? What's your outlook for silver in 2011? Silver went up 75% in 2010. It had a great year. Gold only went up 30%. So talk about that law at the lagging you were mentioning earlier. I think gold has a lot of catching up to do as well. It should have been around 1600. That was my price target for the end of 2010. But what about silver? What do you think of silver?
Well, first of all, let's give a summary of 2010. Like you said, silver was over 75% gains for the year. I think it was actually around like 89, unless it dropped a little bit, 89%. But the top three performing commodities for the year of 2010 were silver, palladium, and cotton. So Jim Rogers nailed two out of those three. I don't think Jim Rogers has exposure to palladium, or he hasn't really been asked that question. But as far as silver price projection goes, I think as long as there's still inflationary pressures, and I think inflation is the thing that investors need to guard against more than deflation. Inflation, like a hyperinflation, and I think we are seeing some hyperinflationary pressures as commodity prices continue to accelerate, higher. We are definitely seeing some hyperinflationary pressures as the U.S. government is bankrupt, and the Federal Reserve is literally basically the only buyer of 30-year U.S. Treasuries. They are the buyer of last resort. The last statistic I saw was from Casey Research about 3 weeks or a month ago, and the Federal Reserve was buying about 94% of all the long bonds. So basically then there is no market demand for that. We're going to see silver prices, I'd like to say we're going to see silver prices approaching $50 by the end of 2011. Now, I don't know if we'll close above $50, but I think there's a lot of fundamental factors that have gotten even better for silver in 2010. And especially, as these Wall Street firms, which were not invested in silver and didn't know the silver story like you and me and other silver bugs out there know it, they're learning, about the silver story right now, about the short position in silver, the positive supply-demand fundamentals, how there's more above-ground gold to invest in than silver to invest in at this point, a lot more above-ground gold for investors to invest in than silver. So I was just looking actually at some bullion, at buying some silver bullion, and there's like a 2 to 4 week wait on 5 and 10 ounce bars at many of the bullion dealers. So there's a humongous demand explosion from silver. And also, Mo, my sources say on the ground in mainland China that physical silver is selling for $37 an ounce US already.
Wow, $37.
So that silver price, the paper silver price and the price here in the U.S. has a lot of catching up to do to the Chinese price, because I think the emerging market demand is on top of the industrial demand is what will drive the silver price. So we don't really need a lot of American investors to invest in the silver price, to invest in physical silver, and I still think the price is going to move. Now, as American investors learn the silver story, I think silver will start moving that much faster, that much higher.
Oh, okay. Well, just to note that China citizens for the first time are allowed to buy gold and silver too. The previous bull run in the metal, that wasn't the case. So if you factor that in, This bull run could be a pretty good one.
Yeah,
I
I
think.
agree with you, Mo. And also, the Chinese government is running commercials for their citizens to buy gold and silver and go. It's easy. It's easy. You should do it. Just go to either one of our bullion mint shops or a local bank and go and buy, gold or silver. So I think that's very bullish for prices. The Chinese, as much as the Indians, have a long history of buying gold and silver. So I think that's going to put a floor in the market here, Mo. What about you?
Oh yeah, definitely. I think silver have a long way to go. I think it started to go in phase two of the bull run that many experts talked about on TV and in the internet. I think people are starting to notice it a little bit more. Starting to talk about it a little bit more on TV. I noticed that. I do think $50 silver is possible at the end of 2011, and $2,000 per ounce gold is possible as well. But you were talking about the mining shares for gold and silver. Um, the mining shares only went up 30% this year, so they lag as well. What is your outlook for 2011? You think they'll have bigger gains compared to 2010?
Definitely, Mo. I think some of the reason the mining shares are still lagging is that people don't believe the gold and silver story. And also there is hedge funds and other large, pools of money that are kind of, short some of the mining shares still maybe and long physical bullion. So that trade was very profitable for a while up until recently where, the mining shares were not producing the cash flows that a lot of investors expected. And it was more profitable to be invested just in physical bullion, but that is starting to change, Mo. The cash flows, and I have looked at a lot of mining companies, and we just put out that gold and silver stock report that you co-authored with Chris Marchese, hedge fund manager Chris Marchese, so you can verify that a lot of the cash flows on these companies are the highest in their history. So this thing is starting to. We don't need. Let me put it this way. We don't need gold and silver prices to go that much higher for these companies to produce record cash flows. You are already starting to see it now. As long as, the energy input costs are relatively controlled and the precious metals prices stay this high or go higher, along with the base metal prices. So I think we're in a great sweet spot here for the mining stocks, and I can still find a humongous amount of value in the gold and silver shares. So I can buy the bullion in the ground because, you and me obviously know how to value these stocks, but we can find great value where we find the bullion at a discounted price in the ground with good production numbers, good cash flows, and possibly dividends, in the not-too-distant future.
I agree. And for those who are wondering about the gold and silver report, you can go to the momoneyblog.com, which is my blog, and purchase a copy of the report for $32. If you go to the tab on my blog, it says buy the gold and silver report. You can click on that and you can buy yourself a copy. Let's talk about one commodity that not many people talk about is copper. Copper just broke the $4 resistance on the chart and look like it's going to continue to climb. What is your outlook for copper?
Well, long-term copper prices are definitely going higher, Mo. One of the main positive fundamental trends that copper has in its favor, and this is a multi-decade trend that's been starting now, is the electrification of developing countries. So you're seeing this in China, you're seeing this in India, you're seeing this in South America, and not quite yet in Africa. So as Africa, is developing and this happens, you're going to see this, but you're going to see a lot of, power grids. You're going to see perhaps smart grid. China attempt to build, a smart grid where, it's very efficient electrically wise, unlike the power stations here in the U.S. And all that stuff requires a humongous amount of copper, especially if we have, like bullet trains and, light rail and stuff like that in cities and metro areas. So like the age and also electric cars. So even electric cars and hybrids require a lot more copper, than the average regular car because, it's electrified there too. So you're going to see a lot more demand for copper, and yeah, now that's long term. Now copper has gone up a lot in 2010, a lot more than I was expecting. And now we could see a correction in copper. Dr. Copper tends to be a forward-looking, indicator. It's considered a forward-looking indicator for all commodities prices. And there's also some behind-the-scenes stuff, Mo, with J.P. Morgan and the attempted cornering of the copper market on the London Metals Exchange. Did you happen to see that?
Yes, I did hear about that. That they bought up 90% of the copper market in attempt to hedge against their losses against silver. Or why do you think they did that?
Yeah, I think that's definitely one of the main reasons what they did. I think they're using the long. I think they're about 90% long copper's futures. They own 90% of all the long futures contracts on the London Metals Exchange in copper. And I think one of the main reasons they're doing that is to hedge their massive silver short position that they inherited, from Bear Stearns after they took it over. So I think they're going to be holding copper, ransom. They can make a lot of money, if they only let a little bit of their copper long contracts go at each time, right? So that can keep the price, that can put a floor in the price basically, and keep the price higher, and that will offset their silver short position. Because copper and silver do have a lot of similar, properties. They're both great electrical conductors. Although silver's a lot more money because silver is valued per ounce. But I think copper is getting a little too speculative here, Mo. I wouldn't be surprised at all if it dropped below $4, maybe down in between like 350 and 4 again, wiped out some of the momentum traders and some of the other hot money that moved in, and consolidated for a lot of 2011 there. But if JP Morgan is controlling this market, all bets are off, Mo. So I mean, like, if you're a trader or an investor, you might want to be aware that, like, there could be a correction, but, like, keep a long position and maybe hedge yourself with options in some of your copper stocks, or like on a copper ETF, like a copper mining ETF. I think there's a copper mining ETF out there, Mo, that was created in the last 4 or 5 months from VanEck, along with the silver miners ETF SIL. So that might be something that people, could buy, like, out of the money puts on as a hedge to protect themselves with their copper long position.
That's a good point. I'm glad you brought up the point that they do have a copper ETF out there that you can trade options with to protect your profits. But another commodity that a lot of people know about is crude oil. Now, oil was went pretty sideways for 2010. We had its ups and downs. You think it'll continue on to 2011, or will that change?
What it looks like to me, Mo, is that towards the end of the year this year here, is that there was continued, downward pressure on the dollar. It looked like crude oil was about to start breaking out of its trading range here, and we did see that to a somewhat certain extent. But for like almost all of 2010, you're correct, it was basically a trading range for crude oil, where anytime it would get like to 90 or a little bit above, 90, like low 90s, it would get hammered back down, and then it would, go to like the mid to high 60s, and it would form a base there, and it was, just a trading range with oil. But as we see, because all commodities are priced in dollars, first of all, for our audience who is not aware of that, as the dollar continues to lose value, that will force, no matter what, it will force oil prices higher. So the thing about this is that a lot of these OPEC countries, like Saudi Arabia and, Iraq and Iran, these countries, as the higher oil goes, the more they want to bring production online. So it will be interesting to see what's spare capacity and if they can keep increasing production online, because, the Saudis have the most capacity. And, these countries that have the massive amounts of oil, a lot of them rely on selling that oil to fund all of their government and a lot of their social programs. So if their economy is hurting, to insulate, it would be smarter for them to, increase the capacity of oil they're selling to help pay off, like, some of their whatever stimulus programs or other construction programs they have, going on inside their own country to, create jobs and stuff. So I think we will see a higher trading range in oil because of the dollar devaluation, but I think we will see a trading range. So I think, because oil prices, the higher they go, and the whole, world economy, because of, how much food and other stuff we buy from China travels just to get to stores here in the U.S. and supermarkets and stuff, because of how much that stuff travels, you can only cut back so much on the oil. So I think like once oil gets to like 110 or 120, that means about $4 a gallon gasoline, Mo. So that's going to become very, very bad for the U.S. economy, especially as, you know, the U.S. economy is very slow to switch to other alternatives and wean itself off oil. We're not doing it nearly fast enough, Mo. So I think around 110, 120 maybe would be the absolute high I could see oil, unless the dollar absolutely crashes in 2011. So I think that would be the high I would put at the trading range for now. And I think like we'll probably, the new floor probably for oil, we might see like a 75, $80 a barrel, perhaps higher, low end of this trading range in 2011, figuring in, the dollar devaluation and other currency devaluation into other people's models.
That's a good point. Well, that wraps it up for our commodity talk for 2011. The main reason we covering commodities is that Wall Street for Main Street thinks this is the one of the few markets that's in the bull run and that people should pay attention to. So we're going to go to our next topic, which is the housing market in 2011. Now, the housing back in 2010 had its up and down. If you recall, they had an $8,000 tax credit for first-time home buyers, which inflated the housing market temporarily. And then also the interest rate for 30-year mortgages were around 4.50 or 4.30, but now it's skyrocketed back to 5% for a 30-year mortgage. So, and I just read an article from Peter Schiff that he's predicting a 20% decrease in value in the housing market. So, what's your thought on the housing market for 2011?
Well, what's the real crash in the housing market, and what's the paper value in the bank stocks? I think people need to understand this and grasp this, and people need to pay attention to those great banking analysts out there first and foremost, like the Meredith Whitneys and the Dick Boveys and the Chris Whalens. People need to pay attention to what these people have to say about the banks and the housing markets and the municipal bond markets and stuff, and that will help, drive additional insights. Peter Schiff is definitely right in his article. But one thing I want to, and I think that we're also in the eye of the hurricane here, Mo. I think we really only hit we're only halfway through, I think, this housing crisis here with the collapse and stuff. But one thing people need to understand is that the bank stocks and others, they might not see the actual honesty and the reality of the housing market because of what the FASB did in March of 2009. And this is very important, Mo. This is perhaps the most important thing that people need to grasp, is that as the Alt-A's and the option arms start resetting, and they're just starting to reset now, really, and this is going to be, the next wave in the housing crisis. Whitney Tilson has a very in-depth book on this called More Mortgage Meltdown, 6 Ways to Profit in These Bad Times. And he's one of the main proponents about talking about, what's going to come. But the banks don't have to mark these, these losses, Mo, on these, mortgage derivatives and their bad real estate holdings. They don't have to mark these assets to market. And that's one of the false, signals that's being given to the market. And that was to keep, to prop up these bank stocks, to prevent, runs on the bank panic, stuff like that. Because if these banks had to mark these assets to market, and they didn't have to value, they weren't allowed to value them however they wanted to now, after what happened, with the FASB rule change in March of 2009, a lot of these banks would be fully insolvent, Mo. So that's part of the thing that people need to watch out for. They need to understand the disconnect, the false signals in the market. So I definitely think the housing market will crash. Now, there's insulated areas, Mo, as you know, since we live right around Washington, D.C. here. This area is pretty insulated for now. A lot of people are moving here. There's a lot of government jobs, still being created even in certain, government agencies to a certain extent. So this area is pretty insulated. But I think like the general trend in the housing market is, like you said, still down. And that subsidy, the first-time homebuyers tax credit, it was a, false signal to the market. It was a fake subsidy. And, being Austrian school economists, the subsidies don't really work that good. So.
Yeah, because it's only work for the short term. Long term, it doesn't do anything for the housing market, because the problem with the housing market is a lot of people are unemployed that can't afford to go out and buy a house. And there's an oversupply of houses out there, and they're still continuing to build houses for some reason. So that's a very bearish signal in the housing market.
Yeah, I agree. Unless you live around the DC area here, Mo, because a lot of these builders have been investing a lot of money into their properties around here to continue to build. And it seems they're betting on the government continuing to expand, or, service sector industries for the government continuing to expand. So this area seems to be the exception and not the rule, but I think the rest of the country, except for, the oil and gas belts in like Texas and Oklahoma, those areas are doing very well. There's booms there. So I think, except for, certain exceptions around the country, I think we are going to see a nationwide, continued decrease in housing prices unless they continue to devalue the dollar a humongous amount, over 10%, 15, 20%, and then we'll see those housing prices either, stay around these levels, Mo, or continue to rise nominally. But the question is, will they keep up with inflation then?
That's a good point. And speaking of the government and what they're doing, just this past month in December, Congress passed a defense spending bill which totaled to be $725 billion for the fiscal year of 2011. And so that will, that will not help the health of the dollar, and continues to add more to our U.S. national debt, which is almost $14 trillion. So what is your outlook on the government fiscal policy for 2011? Will it be more of the same, or will it be different?
Well, after the elections that happened, I know that people were like, Tea Party is going to help this, but like for every Rand Paul, there was a lot of Republicans that won, that switched to libertarian talk and Tea Party talk, and that had, signed off on the bank bailouts of 2008 and 2009. So I'm not optimistic, Mo, that the politicians will make a change until they're absolutely forced. I think they will try other measures, perhaps, including, approving more QE programs with the Federal Reserve. Because let's face it, the Republican Party and the Democratic Party, the majority of the people in both parties use the same economics. So the majority of them use like a mixed model, Keynesian type of model, and that's what they've learned, and that's what their advisors who they consult with have learned, and that's what Wall Street seems to want, Mo. So I don't see any monumental changes. I see even the people in Congress, as they go into Congress now for who won the elections in November, I see them starting to give in too much. I think the unemployment benefits, Mo, weren't they extended another 13 months? And I think it's a realistic possibility that we're going to see some of these states like California, Illinois, maybe New York, New Jersey start to get some bailouts, unfortunately.
Yeah, I agree. Because if you look at the stats, the American cities and states have debt that in total is $2 trillion. And there's not enough tax revenue coming in to pay off these debts. So I wouldn't be surprised if the Federal Reserve or the government decided to bail out the states. So, and also, if they're going to solve this deficit problem, the two things they need to look at are defense spending and the entitlement program. The Social Security is in the hole $28 billion this past fiscal year. Until they fix those two areas, the national debt is just going to continue to rise. What do you think? What's your thoughts on that?
Yes, and I don't see how it can't rise, Mo. I just don't. And yet Obama has stated that his goals, to get us out of this economic hole, out of these deficit problems, and turn things around, is a 50% increase in GDP over the next 5 years. I don't know how he's going to do it, Mo, without devaluing the dollar. I just can't see a way how it's going to get done. because I don't see factory jobs and other jobs moving back to the U.S., more productive jobs moving back to the U.S. that quickly. What about you?
Oh yeah, I agree. Unless they cut regulation and cut taxes dramatically, I do not see those factory jobs coming back to this country.
Yeah, Mo. And California as a leading indicator where you said, they need to cut regulation and cut taxes, the exact opposite is happening in California, Mo. And, maybe there's special sectors here that are getting subsidies here and there where they don't have to pay, certain taxes for a while. But the trend in California is still increasing taxes. Property taxes are going up in California to state residents. And, corporate taxes are going up in California. And that is still forcing corporations and other, successful business people to leave the state en masse. So until this trend reverses, Mo, I think we're going to see continuing things get worse, not better. We're not going to see any kind of market improvement across the board.
I agree. Well, moving on to probably your favorite topic, which is rare earth metal industry. Now, you wrote a report with Kevin Kerr called the Dragon Metals Report. What is your outlook in 2011 for rare earth metal? Because this past month, there's been news coming out of China that they're going to cut their export on rare earths. I believe it's 35%.
Yeah, I mean, this week alone, Mo, like 3 times during the week, there were separate news stories and press releases from, out of Bloomberg and different Chinese regulatory agencies talking about different amounts of export reductions. Like it started off at like 11%, one story, and then it went to 33 and now 35. And you know what? I think what's happening, Mo, is that these rare earths are so key, so vital, and the modern economy is so dependent upon them, and we take all these things for granted, and China understands this better than anyone. And I think the U.S. is finally starting to, catch up and understand some of this stuff. At least some of the politicians are, and a lot of the key businessmen are. But one of the key trends here that China understands is that China is starting to use these as a political, tool. So what we are seeing, Mo, and this is just me putting, pieces of current events together here and there, is as the U.S. continues to devalue, okay, and China has to print money on the dollar peg, and the U.S. wants China off the dollar peg, right? So you're seeing these currency wars develop between China and the U.S., and things continue to escalate, currency war, then a trade war. I think what you're seeing now is that China says, well, U.S. has like a modern service sector economy with a lot of IT companies, and we're just going to cut rare earths. So we don't like, the printing that's going on by the U.S. government, so we're going to hurt the U.S. with the rare earths. So I think that's what we're seeing, Mo. Now, on top of that, there are legitimate supply problems in the rare earths, okay? Demand is definitely increasing. In fact, Lynas released in the last few months, Lynas is one of the top emerging rare earths producers for people out of Australia. And Lynas said that the rare earths market, they're projecting the whole market to grow by about 8 or 9% through 2014. So that would mean by the rule of 72 that it would double in about 8 or 9 years. The whole market would double from about 120,000 or 130,000 tons per year of demand in rare earths to about double that in 2014, 2015. But the new demand estimates that I'm seeing is that it's going to be over 250,000 by 2015, and that was recently released in the last week or two by another analyst. So we could be even accelerating over 8 to 9% growth a year as more of these, solar projects come online, alternative energy, more hybrid cars, a lot of the clean tech and defense apps that these rare earths are absolutely, irreplaceable in. They just have amazing properties in them, and they're not substitutable like the average other commodities are. They're just not, Mo. So I think this is a great trend. A lot of these rare earths juniors that are not near production are way ahead of themselves. There's like 2, I think, that are a lot more ahead of themselves than the rest, and those would be REE, Rare Element Resources, and Avalon. I think people, if they want to go long, they need to hedge themselves on the downside. I think those 2 stocks are way ahead of themselves. But I see good growth in the market here, and I see, Molycorp just bring on good production Molycorp already has, the Japanese were scrambling for rare earths, and they just did 2 big deals with Sumitomo and Hitachi, 2 very big Japanese corporations, for to provide investment for Molycorp to make sure they bring the Mountain Pass deposit back into production. So I see a very healthy market now, Mo. There's a lot of good capital coming into the market, but there is legitimate, supply and demand fundamental stuff, and I think that's bullish for higher rare earth prices, because the cheap prices that the Chinese were giving away, the rare earths at really prior to the last couple of years, are just not sustainable anymore. Not unless China wants to completely kill all of its citizens, poison their soil, poison their water, and, just give away free key strategic metals. So it's not going to happen anymore. The Chinese are now investing even abroad into producers of rare earths outside of China. So even the Chinese are admitting that it wasn't sustainable for them to keep giving away the rare earths at those cheap prices.
That's an interesting point. Why don't you talk about your report that you wrote with Kevin Kerr? I believe people can purchase that report on kertrading.com. Is that correct?
Correct. We're planning an update to the report sometime very soon, and that will probably coincide with our rare earth metals webinar that we have planned, hopefully for the end of January. We're finishing booking up special guests, hopefully this week coming up, for the webinar, and we invite everyone who's listened to this podcast here to go over and listen to our webinar. It's going to be free. And, learn some stuff about rare earths that's probably not going to be, in the Dragon Metals report. And then if they want, a really comprehensive guide, pretty much everything there is to know about how to invest in rare earths, and along with, some stock picks, what to look for, like in the top-down, supply-demand fundamentals and other stuff like that, full guide, then we encourage them to buy the Rare Earth Metals report. Jim Poplava, who manages over $300 million and also hosts the Financial Sense News Hour, called our Dragon Metals report, the first version, a must-read for anyone who wants to put any astute investor who wants to invest any kind of decent capital into the rare earth metals. And as a lot of people who have bought the Dragon Metals report, and we've sold over 60 copies so far in a little more than 6 weeks, can attest, the report is quality.
And that will wrap up our podcast regarding our outlook for the year 2011. Jason, do you have any conclusion you'd like to share with us before we sign off?
Yes, I do, Mo. I'd like to just give a rundown for people. We've talked about bank stocks and the real estate market and a little bit about the dollar, but let's talk about the dollar index really quick. Now, Austrian school decoupling theory, that means the dollar index can still go up and gold and other commodity prices can go up, but the dollar will still lose value to commodity prices because the dollar increasing on the dollar index will not be keeping up with inflation. So this is something I think in 2011, a strong trend that I believe is going to happen more as the decoupling continues to show itself more in a higher percentage. So I expect that it is very possible that, the dollar, quote unquote, being the worst house in a bad neighborhood could continue to go up more, but it will not rise as quickly as gold and other commodities will. So I think people are safest in commodities and natural resource stocks, and I think people, if they're diversified, if they have like a portfolio of like gold mining shares, silver mining shares, some energy plays, some base metal plays, good uranium exposure. I'm really bullish on uranium. We didn't cover that much in this podcast, maybe another one. And rare earths also. I think those types of diversified commodity plays, having a good solid basket of those, are the way to go. And you can protect against the downside with options, buying out of the money puts or other types of hedges maybe. So I think that's going to be a very strong trend for 2011. And I think if people are, well diversified in commodities, I think they will do very well in 2011. And I think if commodities do correct, I think people need to be contrarian. And if they do have cash on the sidelines, or if they do have a lot of commodity exposure, instead of panicking and saying, oh no, I lost, 20% on some of my commodity stocks, I think they need to buy more, Mo. I think they need to train themselves that, I see these fundamentals, macroeconomic fundamentals in the currencies and the commodities and the other things developing out. I don't see anything changing, and I need to continue to build my positions. I know a lot of investors that goes against their programming to average down, but I think smart money is buying on the dips, Mo. I see it. I see it in the gold and silver. So everyone was expecting a silver correction already, and we just haven't gotten one, Mo. And that is because a lot of the smart money is coming in and buying the dips, Mo. And there's a floor in the silver price, a lot of strength that a lot of people weren't expecting, even more strength than you and me were expecting. So I think that if people take a longer term view, and they learn how to hedge themselves, maybe they have to buy some options education material, and they learn that to protect themselves on the downside, they need the long exposure, and I think that's the way to go. And the goal is to beat inflation, Mo. So the goal right now for 2011, for me at least, my goal is to beat 11%, which is the inflation I calculate using the Austrian total money supply that our friend Chris calculated for me. That's my goal, to beat 11% on every single one of my stocks that I pick out.
That's a good goal, and also important to mention what's happening in Europe as well. It will be interesting to see what happens in the Eurozone, especially with Germany complaining about how the currency is being devalued, and also with all the bailout to all the countries like Ireland, Greece, probably Portugal, Spain, and Italy. That's sometime down the future as well.
Yeah, I agree. The thing about Germany is that a weaker euro actually benefits the German corporations, but it doesn't benefit anyone else in Germany. It doesn't benefit the German saver, the German person who is very responsible and prudent and saved their money all these years. So that's a trend you're seeing, where these corporations and the governments who want their debt devalued. You're seeing these large corporations who want their exports more competitive. You're seeing the governments and the corporations get preferential treatment over Main Street people like you and me. So I think people need to protect against that, and I think commodities are the best way to do it. And besides that, in the euro, Portugal and Spain are probably next on the block here, and Italy sometime down the way, although Spain seems to be the biggest threat since it's so large. And then Estonia just joined the euro here, and they're saying how strong the Estonian economy is. And yet, I was speaking with Kevin Kerr for the last few weeks a lot, who just moved to Estonia, and he was telling me that the residents in Estonia, Mo, on the transition to the euro, they don't like it, and they're buying gold and silver nonstop in the bullion shops. There is long waits to buy gold and silver. So look at the disconnect that is occurring between the government centers of these countries and Wall Street and people like you and me on Main Street.
And that will wrap up our Wall Street from Main Street podcast, our outlook for 2011. Jason, why don't you give our audience information on how they can find more info regarding what you do and stuff like that?
They can find most of my work on my blog at jasonburack.com, JASON, B as in boy, URACK.com. They can also find some articles I write on other publications, like other investing websites like the Daily Commodities or GoldSeek, and also maybe perhaps Financial Sense in the future if I am not busy writing reports for people. Other than that, Mo, they can, if they want to talk to you and me, they can check out the Wall Street for Main Street Facebook fan page, and also the Wall Street for Main Street Twitter page, and also the Wall Street for Main Street YouTube channel, where this podcast is probably going to be posted.
Well, that wraps it up for tonight. Thank you, Jason, for your time.
Thanks, Mo.
This is the Wall Street for Main Street podcast. We hope you guys out there have a good year in 2011. So good night and good luck.
Happy New Year to everyone. Wish everyone a very profitable 2011. And definitely learn some hedges in place, too. Have some hedges in place, but definitely be long. Okay, bye, everyone.